Subscribe to our YouTube channel and press the bell icon to get the latest updates.
In September 2022, India overtook the UK to become the world's fifth largest economy. If you consider that just a decade ago, India was at 11th position, this is no mean feat. With the way India seems to be forging ahead, most experts have already predicted that India is on course to be the third largest economy by 2030, trailing only the US and China. But if India is to become a $5 trillion economy by 2026-27, as projected by India's Chief Economic Advisor, Nageswaran, it means certain sectors will have to lead the charge and outperform. Over the years, the services sector has been the engine of growth for India's economy. Even today, it contributes to over 50% of the GDP. However, in recent times, manufacturing has emerged as one of the highest growth sectors in India. The Government of India's initiatives, like the National Manufacturing Policy, aims to increase the share of manufacturing in GDP from the current 15% to 25% by 2025. This translates into the manufacturing sector growing from approximately $450 billion to over $1 trillion in the next 5 years. And this could be a huge opportunity for investors. After all, identifying a sector is one of the most profitable aspects of investing. Any intelligent investor who has been tracking the latest developments in India's growth will agree that manufacturing is going to be the next big story. But if you ask them specifically how it might help them make money from this mega trend, they would probably be clueless. Anything related to the stock market is not as simple as we'd like it to be. The manufacturing space is enormous, encompassing so many different subsectors. So how does one identify which of these subsectors could benefit from this opportunity? Now, while analyzing an industry, one must look at the market size of its subsectors and their expected growth rates. Investing is not about the size of the fish. Rather, it is the size of the pond that matters. If the size of the pond is big, eventually the fish in it would also grow bigger in size. Hi, this is Yazad. Over the coming weeks, we are going to be covering the top subsectors and the best stocks within these subsectors that could be major contributors in helping the manufacturing sector grow to $1 trillion over the next 5 years. Here is the first part of this interesting series. Keep watching, and I hope this helps you in some way. India is the sixth largest producer of chemicals in the world, and the total industry size stood at $178 billion in 2019. In recent times, the chemical sector has seen mammoth tailwinds due to initiatives being taken by Western countries to avoid concentration of manufacturing activities in China. The Indian chemical sector has been growing at a rate of 1.2 to 1.5 times the GDP. At present, 30% of India's chemical requirements are met by imports to meet its growing demands. Now, with demand expected to grow even further, it will create sizable opportunities for the development of large-scale capacities and infrastructure for manufacturing various products. The chemical industry is one of the most significant contributors to the growth and development of an economy. For instance, did you know that the industrial development of any country is measured based on consumption of sulfuric acid? It's because sulfuric acid is practically used in every important industry and hence is a leading economic indicator. More than 80,000 chemicals are manufactured in the country and are consumed in diverse end-use sectors, including agriculture, packaging, pharmaceuticals, textiles, automobile, construction, and electronics. India's chemical industry is expected to reach $304 billion by 2025, clocking an annual growth rate of over 15%. Now, this means it could contribute to over 30% of the total manufacturing GDP of the $1 trillion expected by 2025. With global companies seeking to de-risk their supply chains, which are dependent on China, the chemical sector in India has the opportunity for significant growth. An investment of 8,000 billion rupees is anticipated in the sector by 2025. With huge domestic consumption and superior manufacturing skills across the value chain, India could become the most attractive global chemical and petrochemical manufacturing hub after China. Here are the top 5 chemical companies to watch out for. Tata Chemicals operates in both basic and specialty chemistry. The company has the largest saltworks in Asia, is the third largest soda ash manufacturer in the world, and is the sixth largest sodium bicarbonate manufacturer in the world. Tata Chemicals has 13 manufacturing plants across the globe with over 4,600 employees across 4 continents. The company provides key ingredients to many of the world's leading brands for glass, detergents, pharma, biscuit manufacturing, bakeries, and other industries. Innovations in its specialty chemistry business have led to establishing Tata NQ, India's first and only nutritional science business. Tata Chemicals is expected to contribute to the electric vehicle business of the Tata Group by entering the lithium battery space. Through its subsidiary Rallis India, the company is already in the agrochemicals business. This could give it an edge. Over 50% of Tata Chemicals' revenue comes from its key product, soda ash, which is in a sweet spot due to demand exceeding supply. Soda ash is mostly used as an ingredient in the manufacture of dyes and coloring agents, synthetic detergents, fertilizers, glass, and gum. Demand for soda ash is being driven by rising construction in emerging economies, particularly India. It is widely used in the construction, paper, and textile industry, among others. The chemical is also used for air purification and water softening as environmental concerns rise. Supplies have been unable to keep pace as there is limited spare capacity. The global soda ash demand is expected to exceed production by 3 million tons per annum till 2025-26. For the financial year ended March 2022, the company reported a 24% jump in revenue to 40 billion rupees. The net profit rose 67% to 8 billion rupees. The stock has been on a tear since July 2022, rising from just under rupees 800 to touch a high of 1200 rupees recently. This could be after the company reported better than expected earnings for the quarter ended June 2022. Net profit increased 45% quarter on quarter. Operating margins have also improved from 34% in March 2022 to almost 46% in the June quarter. The global demand environment continues to be positive across the company's products and their applications. This, coupled with the ongoing programs on driving cost reductions and efficiencies, will likely yield benefits in margins. Tata Chemicals seems well positioned to continue its growth journey. BASF SE is a German multinational chemical company and the largest chemical producer in the world. BASF India Limited, a subsidiary of BASF SE, is a leading multinational company. The business is organized into segments, namely chemicals, industrial solutions, performance products, materials, surface technologies, and agricultural solutions. The products manufactured cater to sectors including agriculture, automotive, pharmaceuticals, construction, consumer durables, consumer care, paper, and paints, to mention a few. Now, these businesses have a strong technological support from the parent company BASF SE. The company's financial performance has improved significantly over the last few years, even during the challenging pandemic years. Revenue growth has come on the back of a combination of increase in pricing and volumes. This is commendable. For instance, the company has significant exposure to automotive. However, automotive production in India was stagnant and even worse in 2019 and 2020 because of the pandemic. Despite that, the company grew its business in the automotive sector as well as in the agriculture and chemical segments. Earlier, the agricultural segment was a major contributor to revenues, but in recent years, the revenue mix has been well spread out across segments. Over the last 5 years, revenues have grown at a CAGR of 24% from 2018 till 2022. Now, this is an incredible feat considering the disruptions due to COVID 19 and the Russia Ukraine conflict in terms of supply chain disruption, inflation, crude oil prices, and so much more. Net profit has also jumped 146% from 246 crores in 2019 to 595 crores in 2022. Even with the change in business model, the net working capital has not changed significantly. Hence, the ROCE, which was at just 1.4% in 2019, has shot up to 35.8% in 2022. On the other hand, the company has been repaying its debts, including the over 10 billion rupees external commercial borrowing borrowed for the Dahej plant, which was fully repaid. Hence, with fiscal prudence, the company is now debt-free and in a very well-managed capital situation. With the current rising interest rate scenario, interest costs would not directly impact the company going forward, at least for the time being. The stock is off its yearly high of rupees 3,358 reached in August 2022 and is currently trading under rupees 3,000 levels. Incorporated in 1947, PI Industries focuses on complex chemistry solutions in agri and pharma sciences. PI Industries is the second largest agrochemical company in India and India's largest CRAMS company with majority revenue from patented products. The company maintains a strong research presence through its R&D facility in Udaipur, where it has a dedicated team of over 400 plus researchers and scientists. PI Industries has 3 global locations: Japan for business development activities, China for sourcing, and Germany for knowledge management. The company is focused on portfolio diversification with the launch of novel offerings. Strong demand is expected for insecticides, fungicides, herbicides, and bionutrients in the future, even as commodity prices remain robust owing to rising global demand. The company has 5 new products scheduled to be launched in FY23, in addition to continued scale-up in demand of some of the existing products. Now, record food inflation coupled with supply chain constraints is expected to drive healthy agrochemicals consumption, and PI is rapidly broadening its product offerings across agrochemicals, electronic chemicals, and the pharma space. The company's revenues have grown 120% from 2,308 crore in 2018 to 5,076 crores in the financial year ended March 2022. Profit after tax, on the other hand, has jumped up by 124% from 366 crores to 819 crores over the 5-year period. Despite the constraints in the operating environment, such as supply chain disruptions, rising input costs, and unfavorable climatic conditions, PI's revenue growth for the financial year ended 2022 was powered by price increase and volume growth. The company has been able to maintain EBITDA margins and ROCE of around 23% and 21% respectively over the last few years. PI Industries closed at around 3,125 rupees on 26 October 2022 and has given flattish returns since the beginning of the year. Since its inception in 1959, Pidilite Industries Limited has been a pioneer in consumer and specialties chemicals in India. The company has a diverse product portfolio which includes adhesives, sealants, waterproofing solutions, construction chemicals, arts and crafts, industrial resins, and polymers. The company operates some well-known brands like Fevicol, M-Seal, Dr. Fixit, WD-40, and many more, which have a strong awareness in both consumer and industrial segments. Its market dominance is also near monopolistic in Fevicol and M-Seal, which contribute a major portion of the revenue. The company has 9 manufacturing facilities outside India and has operations in 71 countries across the globe. The additional spending in government programs like rural employment schemes and higher capex spending emphasizes the focus on infrastructure and increasing disposable income in the hands of common people. This will act as a catalyst for the growth of the economy, which will eventually create demand for the company's products. The home improvement area offers significant opportunities for growth given the focus on affordable housing, new construction, as well as renovation. The management expects the company to grow at 2 to 4 times of the GDP. It seems logical, with the economic growth happening all around in India, that Pidilite would be bound to grow, as its products are key ingredients to this mix. The rural region contributes 33% to the company's overall sales, and Pidilite is looking towards increasing its rural penetration over the next few years. As per reports, the company has increased its reach to 17,000 villages in the last 6 months alone. Pidilite's annual revenue growth of 35% for FY 2022 outperformed its 3-year CAGR of 11%. Net profit also jumped by 17% to 12.7 billion rupees in the financial year ended 2022 from 10.8 billion rupees in the previous year. The stock started off this year on a positive note at around 2,500 rupee levels, but drifted lower over the next 6 months, reaching a low of 1,988 before rallying once more to gain 46% to close at 2,916 in just 3 months later. It currently trades at around 2,600 rupee levels. Mumbai-based UPL, valued at around 550 billion rupees, is the 5th largest post-patent agrochemical company in the world. The company produces industrial chemicals, chemical intermediates and specialty chemicals, and also offers crop protection solutions. UPL offers a range of fertilizers and agricultural chemicals, including herbicides, insecticides, and seed treatments. It also sells other products used to stimulate plant growth, store crops, conserve water, and a line of disease-resistant seed varieties. In 2018, UPL acquired Arista Life Science Incorporated for $4.2 billion in a deal that transformed the company into one of the world's largest generic agrochemicals firms. With over 13 manufacturing units in India and 3,800 plus employees, the company is present in 122 countries across the world. The company has outperformed guidance in the financial year 2022, led by a solid business model. For FY 2023, the company has increased guidance for revenue growth to 10% plus, while keeping EBITDA growth at 12 to 15%. The company's share in global crop protection market is 8% currently, which is expected to increase to 9 to 11% by 2027. Favorable market conditions such as high costs and reduced availability of fertilizers impacting yields will favor the use of biosolutions and conventional crop protection. This could boost the company's revenues in the years to come. In April this year, the company commenced a buyback from shareholders at an average price of 813.9 a share. However, the stock plummeted over 24% within a month of the buyback to touch a yearly low of 608 rupees. The stock closed at 678 rupees on 14th October 2022 and is down over 12% since the beginning of the year. And with that, we come to the end of our coverage of the first subsector, which could potentially help the manufacturing sector reach the $1 trillion mark by 2025. I hope you found this information useful. Stay tuned for the second part of our series to find out the next subsector and the stocks within that sector to watch out for. Thanks once again for watching. Until next time, happy investing.